Hey guys, Frank here and welcome back to the New Vision channel where we talk about all things real estate. Now our goal with this channel is about learning and sharing sound principles of starting and growing a viable real estate business or any other business for that matter. In this video, we continue the series on real estate bookkeeping. And some of the things we are going to share in this video assumes that you are familiar with previous videos. If you are new to the channel, you can follow the preceding videos in the playlists shown. Our focus today will be on the balance sheet report, which is the third of the trio of reports that you need to get familiar with in order to understand and better run your business. The other two being the income report and the cash flow report, which we covered in the last two videos. The balance sheet report seeks to address the question of ownership for a business. And unlike both the income and the cash flow reports that cover a period of time, the balance sheet report is a snapshot of the business at a particular date or point in time. So, a balance sheet always starts with the date for which the report was run. First, it starts with a clear statement of what the business itself owns. These are the assets of the business. And that is followed by a clear statement of who can make claims to these assets. And these are either the creditors of the business or the owners of the business in the form of the business's liabilities and equity, respectively. When you look at it this way, you immediately notice that there is a relationship between these categories. Perhaps this is one of the most important relationships in all of modern day accounting, and it is a reflection of the relationship between the business and its stakeholders. It states that in order to do what it does, the business must own certain assets, and if you take away all the liabilities or what the business owes from these assets, what is left over is what the owners of the business can lay a claim to in the form of its equity. Please note that the word equity as used here is in an accounting sense. And this is different, although related, to its common use in real estate as the difference between the market value of a property and the loans owed on it. As we stated in an earlier video, the specific accounts under each of these main categories of assets, liabilities, and equity can vary depending on your personal choices and perhaps what the tax or accounting authorities might require in your area. However, there are some typical accounts that would apply for certain types of businesses. For example, in a real estate rental business, the assets would typically include things like the opening bank account of the business, the escrow account that holds tenants and other deposits to be refunded at a future date, the actual building and other real property values, etc. Similarly, the liabilities of the business would be things like the mortgage principal, credit cards, security deposits, etc. And finally, on the equity side, you would find things like the owner capital contribution, owner withdrawal, retained earnings, etc. We have explained what these various subcategories or chart of accounts are in a previous video. If you were to look at the balance sheet of a large real estate or any other large business, you would likely see many more subcategories of accounts under each of these three main categories of assets, liabilities, and equity. These are just details and should not confuse your understanding of the main points. As we cautioned in a previous video, it is particularly important to keep it simple in the beginning in order not to get overwhelmed. As you get comfortable with handling the simple categories at the start of your business, you will be able to take on more detailed breakdown of these categories later. To give you a more concrete example of a balance sheet report, let us look at what it might look like a few months after you start your real estate rental business. First, on the left-hand side, we can see the assets of the business. And under the assets, we can see that the operating bank account currently holds a balance of $3,000. We can also see that the escrow account holds a balance of $1,000, probably from your very first tenant security deposit payment. Finally, we see that you created a real property asset of 123 Main Street, representing your very first rental property that you acquired for a total of $122,000. So, the total of the business assets as of this date is $126,000. Looking on the right-hand side of the balance sheet, we record the liabilities of the business in no particular order, starting with the mortgage principal that you took on in order to acquire the property at 123 Main Street at a value of $80,000. This is followed by the security deposit of $1,000 that your first tenant paid, which we also saw in the escrow account in the assets column. We also see that the business had taken on a short-term credit card loan of $500, perhaps for repairs or supplies. These together make a total of $81,500 in liabilities. Finally, we see that your equity claim in the business includes the initial capital that you contributed to the business, captured in the owner contribution account at $40,000. Since your business just started, we see that you have not yet withdrawn any money from it. Hence, the owner withdrawal account is still at zero. And since your rental building was in good shape when you acquired it, most of the rent that the tenant has been paying so far shows up as retained earnings. But don't let this part fool you. Later on, you will start making additional expenses, especially for repairs and taxes, so your retained earnings value would likely go down. From this simple example, you can see the accounting relationship in play. That is, the assets of the business is equal to the sum of the liabilities and the equity of the business. That is, $126,000 in assets is equal to the sum of the liabilities of $81,500 and the equity of $44,500. Another way of putting this is that the assets of the business minus the liabilities of the business is equal to the equity for the owners. That is, $126,000 of assets minus $81,500 in liabilities equals $44,500 in business equity. We will conclude by saying that when you are starting out in business, the balance sheet report may appear not to be the most important consideration, since you are just concerned with survival at this stage. But the longer you stay in business and your business becomes more consequential, the balance sheet report starts to take on more importance, as this is one of the key metrics in valuing your business if you want to sell, for example, or assessing the riskiness of your business if you are looking to raise funds from borrowing. A buyer of your business may want to see that whatever you are asking as a sales price is supported by the assets of the business, amongst other things. And on the other hand, a lender might want to make sure that you have enough equity in your business to shield them from the loss of their principal that they are giving you or your business as a loan. And the way to know these things is to run a balance sheet report. Please let us know in the comments below if you find this type of content helpful. You would be encouraging us to create more by clicking the like button and subscribing to our channel. And while you're at it, please click that notification button so that you would immediately know when we put out new content. Many thanks, and see you in the next video.